Friday, December 14th. I'm in one of my early Christmas neckties. This is the one with the geese and chickens and a pear tree. On everybody's mind, I think in the background, is this business of the stock market wandering all over the place, lurching. And housing is what we really care about. There's a linkage, maybe. It's one of many Barnes theories about how the world works, and it'll take me a second to get to it. But the stock market, from the end of the Great Recession in early 2009, went straight up. And if anything, steepened after the election in 2016. The recession bottom in the spring of 2009, in Dow Jones terms, was a market value of 7,000. The top this year was 26,600. So not quite fourfold increase in the value of the stock market. Nothing goes straight up, especially in market space. Anything with a run like that is due for some kind of retreat, which the stock market people call a correction. Prior to the Great Recession, there was reasonable stability in a range, in the low teens, between 11 grand and 15 grand. So the stock market may have quadrupled from the recession bottom, but it really hasn't even doubled from the high values in the early O's. It is way higher, of course, than it was prior to 1990. In 1990, whenever you look at any of these charts, especially the stock market, 1990 marks the beginning of globalization. That's when the Iron Curtain came down. That's when China opened. That's when Russia opened, and Eastern Europe. And not coincidentally, by the way, within the following 3 or 4 years, all of us got our first email addresses. Never underestimate the linkage between those two things. The IT revolution facilitated globalization, and the global phenomenon, many people are annoyed with it, with its dislocations. Many people are angry about it. But there's never you could argue that the Industrial Revolution itself did not create so much wealth so quickly as globalization did in so many places at the same time. The stock market trading pattern, other than just this business, we're still a little ways above a danger zone, which, if the Dow falls another 600 or 800 below where it closed today, then we could begin to lose some more ground, and that may have an economic effect as a sort of reverse wealth effect. But just today, the stock market trading pattern changed. The trading pattern going back for months has been any sign that we are about to slap tariffs on China, and presuming that China would react very negatively, if only to being treated that way. China has misbehaved. It does need correctives, but nobody likes to be humiliated in public. Every day it looked as though we were going to impose tariffs, stock market down. When it looked as though there'd be a trade deal, stock market back up. And months and months and months of that until today. Today, China, although lost in the news, appears to have agreed to suspend all tariffs on imports of American automobiles. It has decided to buy a whole lot of soybeans, whether it needs them or not. Significant concessions which it had resisted making in any way. And yet the stock market tanked today. And it tanked on news that both China's economy and the European economy are nosing over. And China has manufactured its economic data for a long time, but the data that was out early this morning is beyond the ability to camouflage. China has fed its internal growth with an extraordinary increase in domestic debt, a lot of it bad debt, and also by predatory exports. And both of those channels are now closing down. Europe is, the whole Brexit, European Union, Euro currency is the kind of thing that if you set out to make it up as a joke, you couldn't have. But these earnest people digging in deeper to bad positions And also yesterday, the European Central Bank said that it was finally going to pull back from the last of its stimulus of the European economy. And it's not clear, given the European Treaty, even if the European Central Bank decided to come to the rescue of Europe, whether or not it has the power, whether or not it has the legal ability. So Italy is where Italy always is, but France has joined the chaos. And Brexit is really an ugly thing for the United Kingdom and Europe itself, in which Europe is desperate to keep the United Kingdom in the European Union, no matter what damage it does, so that nobody else tries to leave. That's what took the stock market down. Now back to housing. Housing has begun to sag in several markets almost simultaneously since summer. The sag is in a few of the very few urban areas which still have land for concentric annexation and development. Houston, Los Angeles, Phoenix. Most urban areas are in complete land exhaustion. Seattle, San Francisco, Denver, Boston, New York. Seattle rolled over early this year. Denver really early fall. Other spots now beginning so both land plenty and land scarce at the same time. What else is simultaneous with that? Correlation is not cause, but what else? Mortgage rates touched 5. The math of affordability says that 5 is not a big deal for affordability, but it certainly had shock value. It's hard for me to believe that it's an accident that housing started to slow in a bunch of places just when we started to say 5. But the second thing is the stock market. There is no base of data that I know of identifying the direct movement of cash from stocks to houses except at this desk. Clients who won the IPO game, clients who were on the winning side of stock options, other clients who did not hit the gong that way. Everybody with a 401k, even if they didn't put any money into it, has watched the damn thing quadruple in 10 years, which emboldens us. It makes us feel safe. It makes us feel ahead and not behind. So I suspect that the stock market difficulties in the last couple of months have contributed to the housing slowdown. Housing itself, despite the negatives that I've run through, housing itself is doing fine. This is the only housing market in U.S. history in which credit has not gotten easier as the expansion has rolled on. It's the only expansion in U.S. history in which every homeowner had to qualify on real terms. So we have the most resilient group of homeowners that we've had. We've worked off all of the distressed housing, and it's almost impossible to get to an overbuild in a market which suddenly has to go to liquidation, pulling down other housing values because builders can't find any land to build on. It's a very puzzling aggregate picture, but as the first lines in the newsletter pasted nearby, the U.S. economy is fine. The outside world is not so fine. But in many ways it's to the benefit of the U.S. economy. All of the trouble overseas leads to downward pressure on inflation, which means the Fed will tighten again next week, and that may be it. May have one more to do. But the pre-recession characteristics are the Fed fighting inflation here, and as it does so, it runs into overheated, overextended housing. Not the case this time. One more of these before Christmas. Thank you very much.